Okay, good afternoon, everybody. Thank you very much for joining. Good to see all those that are on so far. We're going to give it a minute or two, just let additional people. Here we go. Everybody's coming in. Good to see everybody. Thanks a lot for joining, everyone. Just give it a couple more moments. A good amount of people here still coming in. And we appreciate everybody taking the time. It's good to see everybody. And without further ado, we'll get started. I think some additional people are coming in, but we want to be mindful of everybody's time. Our goal here for this market update is simply to let our current investors and future investors know kind of what we're seeing in the market. We're going to try and be super sensitive also to everybody's time. So we're going to try and cover as much as we can and as valuable, the most valuable information that we can in a short period of time. So we appreciate everybody's time that you're here, and we look forward to going through this. So just a real quick, today's panelists, myself, and we have with us David Molitor, our head of operations, and Cesar Nguyen, the director of acquisitions at HLC Equity. And we're gonna, our goal is to give a little bit of perspective on each one of those factors. Okay. Thank you very much. And there's a reminder here, anybody who has questions, we have some questions that people sent in already that we'll try and get to. And if people have questions along the way that they'd like to bring up, we're happy to try and get all those questions in, or try and answer as much as we can. Okay. So I'm going to give a little bit, just an overview of the macro environment from our point of view. I don't expect any of these the things that I point out here to be particularly new to anybody that kind of follows the news, and everybody who looks over general, the macroeconomic environment, both in the United States and in the world. But this is kind of from our point of view, how we're viewing things. And so we'll just get right into it. So at the global and US national level, CPI, the consumer price index, grew a mild 0.2% in July, which was the same as June. The July rate hike marks the highest level that overnight rates have been at in 22 years. So that's what this graph is showing here. We have the historic impact of increased Fed funds rate, and it's still, where everybody's waiting to see what that impact what the full impact will be, but we definitely are seeing that there are impacts. So we have a now the inflation numbers as of August 10th lowered the 3-month annualized rate of core inflation to 3.1%. And that's the lowest such reading that we've had in 2 years. And so I guess kind of the question that remains is Powell and Fed analysts that they've stated that their base case scenario is still a soft landing. It's important to note that historically speaking, substantial increases that, like what we've witnessed over the last year, generally have always led to a recession, or at least based on everything historic that we know. So that's kind of what we're grappling with, and what most investors and people who are dealing both from a consumer standpoint and from an investment standpoint are grappling with. Kind of some macro trends that are in our sight. So obviously there's always two sides to every story. So here we have indications that inflation is getting better and it's under control, and the Fed may cease to raise rates at the September meeting, and a new tone of rate policy could be put into place. On the other hand, and that would be obviously good news, but on the other hand, the good news could be temporary. The news that just came out earlier last week and throughout the last several months could be temporary. There are already signs of a potential reacceleration in demand, which would require the Fed to continue to raise rates later this year. The economy, particularly inflation, is still an open question. Obviously, it impacts everyone. All of this speaks to the fact that we're far from being out of anything definitively. We have not avoided a recessionary period necessarily, and the economy, particularly pertaining to inflation, is still very much an open question. So that's something that obviously is on our minds and is on everybody's minds right now. On top of all of this, there are the recent downgrading of the U.S. credit rating by credit rating agencies. In practicality, I question how much that really changes the credit, because the credit agencies they have their own issues that they're dealing with, and their credit standards are also questionable. But it is something that can change perspective. So I think that matters, on a global stage when you kind of think about an investment criteria. Here's just 7 select factors that are impacting CRE investing, commercial real estate investing right now. This is kind of some things we have our eyes on. Obviously, there's more to it, but these are kind of areas that we're focused on. So you have consumer spending on the one hand, where and we'll discuss more how this pertains, and Dave will get into this on an operational level, how this pertains to our consumers from a rental standpoint. But on the one hand, you have credit card debt, which has gone up. On the other hand, you're starting to hear and see signs of weakening purchasing and demand in areas like travel, some areas of hospitality, restaurants, and so forth. So still an open question, but it's definitely something that we very much have our mind on. And again, we'll get into that and how that pertains to our portfolio in leasing in a bit. Relocations causing shifts. So, there's some indications that I think that from our standpoint, there's still a lot of uncertainty around relocations and everything that happened throughout the pandemic, and how that kind of relates to our portfolio at the moment, and multifamily as a whole at the moment. So it's very hard to tell, but we do have some initial indications where in some circumstances on our portfolio, we may have a lot of relocations, which increase demand in specifically in our midterm rental program, but also just in certain pockets of, let's say, DFW, which it witnessed tremendous growth throughout the pandemic, and so now it's kind of you're seeing less relocations to certain pockets of DFW, and then we just have questions that we're tracking, like, what does this mean for the Sun Belt overall? Are there going to be, now the Sun Belt witnessed great relocations to the Sun Belt? Does that mean that there will be relocations possibly away from the Sun Belt if affordability becomes an issue? Those are kind of some of the issues when it comes to relocation that we're grappling with. Obviously, there's the decrease in commercial real estate values, although demand for multifamily does remain very strong. So that's the main driver of that has been the current capital market volatility. So the other factor, which it is driven by the capital market volatility, is the mortgage originations are down. According to MBA, the Mortgage Bankers Association, 55% year-over-year drop in mortgage originations in Q1 2023. Obviously, that's a big drop. They're also predicting a major rebound for lending in 2024. I think based on some numbers we're going to get into later, that's questionable, but that's what they've stated. So another factor is capital is tight, obviously due to the factors that we mentioned above. And so that obviously immediately impacts the ability for transactions within the real estate sector. But there's a major difference in this cycle because there is this there's a lot more presence of alternative lenders, debt funds, and stuff of that sort. So there is actually, in some ways, additional sources of liquidity. It doesn't mean that that everything is rosy, but it does mean that there are different liquidity sources, which makes it different and somewhat interesting this cycle. Number 6 is pricing discovery of acquisitions. Obviously, major issue with acquisitions is the pricing discovery. Who's right? Buyers want a bargain. Most sellers are not distressed. And as of now, they're not in a rush. That may change, but as of now, you're not seeing major distressed sellers yet. So there's no significant forced sales throughout the market of note. I mean, there are pockets and there are here and there, but it hasn't hit the market in a major way. Caesar will discuss that further down the line and what he's seeing. And then we have the number 7 is rising operational costs. Most notable are insurance, labor, and interest expenses. But really across the board, obviously, as inflation kicks in expenses are rising. We're going to dig deeper on these items and some of what we're doing to mitigate these challenges as well that Dave will get into. So bottom line from, kind of like a high level perspective, there's significant changes or challenges persist for both the overall economy and for the commercial real estate investment market. Real estate tends to trail the overall economy. And a tighter debt market has the potential to unlock significant opportunities for fresh capital as some squeeze borrowers are, they need options. Despite the drop in commercial real estate values in the short term, the fundamentals of necessity-based real estate, such as multifamily and some necessity-based retail that we invest in, is still the demand is still very much there for long-term investors and people who can kind of see through the various cycles that we're going through. So with that in mind, there's currently a unique opportunity to purchase properties at a significant discount to what they were trading at just 2 years ago, even if it's not under the most distressed circumstances. So the bottom line is there are many of challenges out there, but there's also opportunities emerging, and we're going to get into some of that. So without further ado, I'd like to call on Caesar to please let us know what he's seeing and what's going on in the acquisitions side of our business.
Thanks, Daniel. I appreciate it. So on my side, on acquisition and capital market, the main headlines on the headwind is volumes way down compared to last year. So Q2 2023 volumes about down 70% plus compared to the same time last year. And in Sunbelt market, Dallas, Fort Worth, San Antonio, Atlanta, volumes even down further. So even look on a trailing 4-quarter basis, Sunbelt market, volume is down more significantly compared to national average, which makes sense because a lot of this market are the darlings of investor over the last few years. So naturally, we'll see a corrections. Overall, I see it on our own activities. This time last year, on average, I see about 200 deals per month going to my desk, and now the number going down to a third, about 70 to 80 deals a month. So but on the other hand, we see improvement in deal quality. So if we go to the next slide, we'll talk about on the next slide, the cap rate had expanded quite a bit compared to last year. So overall 25 bips with 50 bip expansions compared to second quarter of 2022, depends on deal quality and market. But it's still a gap between the bid-ask spread between what sellers are looking for, and most sellers are asking 4.75 to a 5 cap, versus buyers are asking mid-5 to 5.75 cap. So there's still a disconnect in pricing there. That will change over time because this time last year that gap was 100 bips, but now it's at time to 50s, which is a good indication of where sellers and buyer are negotiating on pricing. In terms of the active buyers in the market, though, the main group that I see are still 1031's buyer, as well as private equity fund with dry powder that need to deploy capital. And those guys are typically focused on higher quality asset in good locations, and like Class A properties. And if you go to the next slide. Sorry. Yeah. So in terms, and so how are the people doing? We still in the early innings of distress sales opportunity. I see a lot of distressed operator syndication group with limited liquidity. They are now navigating the loan workout with lenders. A lot of this group, with deal that they bought in 2019 or 2020, they have some built-in upside. They have sold to raise liquidity for their platform, but deal that they bought in 2021 or 2022 are in more challenge because their cost basis, high leverage. Some of this deal they put on floating rate debt at 85, 90% leverage, and now they cannot refinance, and the DSCR is below 1.0. So some deal will go back to lender possessions, and we'll go see foreclosure, but haven't seen it just yet. We're still in very early inning of that. We have seen a decent amount of distressed deal come across our desk, but these are early in the down cycle where it tend to be classy property in classy locations. These property have high bad debt, high vacancy, and really require extensive work on management and capex to bring it around. So for us, we say no to a lot of those deals, and even for us to engage, the pricing had to be even lower to the point where lender may have to take a loss anywhere between 10 to 20% haircut for us to make the numbers work on our end. Next slide, please. So what we are watching? So right now, our main focus is identify motivated sellers. So over this year and next year's, there's about $17 billion CMBS loan, multifamily loan that coming mature that we identify as in trouble, where the DSCR is below 1.0. And so we have our own list of deals that we are tracking that we know that over leverage and also performance had deteriorated over time. And we have been proactively reaching out to lenders to have early discussions to understand where they are. And so that way we can be in the mix when foreclosure happen, and we can be in standing to bid for these deals. Next slide, please. So our focus at the moment, we focus mainly in high growth market with strong job growth and low cost of living, because in our view, this will provide the fundamental needed and the demand for sustained rent growth for our portfolio. Sunbelt market is still our main focus because of a lot of migration happening here. And in terms of deal and a sourcing deal for our investor, we've been remaining disciplined. We only source deal at attractive pricings, and we target a barbell approach where both income and growth. On the income side, we mainly target Class B workforce housing that we buy at a 6 cap or above, so that way we have neutral leverage going in. Or we find deals that have attractive in-place fixed rate financing that we can assume. Those will allow us to drive high cash on cash for our investor. And we have seen some deal coming to our desk, and we actively in conversation with seller to make the deal happen. We get a lot of no's and some maybes, which is a good thing. But hopefully we'll get some deals coming through very soon. And then on the growth side, we target a lot of Class A property that are under construction that should be delivered soon. These are from developer and builder that have upcoming construction loan maturity that need to get out for various reasons, whether they cannot refinance or they want to get out of the loan guarantees, or they have future deals in their pipeline they want to deploy capital to purchase to take advantage of market mispricing at the moment. We are actively talking to them to see if we can strike a deal to happen. A lot of this deal will take somewhat of a creative financing structure, thinking outside the box to make it happen. But we really like this space because this, brand new Class A property in a good location is an ideal target for long-term growth for our investor. Overall volume way down, pricing is still not there yet. But over the next 6 to 9 months, we are very excited to see what opportunity will come to our plate, because we can buy deal at really good basis and drive really good return to our investor. That's it from my end.
Okay, Cesar, thank you very much. It was a lot packed in a short period of time, so we appreciate it. We have some questions that came in, and we will get to those at the end. I'd like Dave now, please. Dave will share kind of what we're seeing operationally, both in terms of our portfolio and also just on a more macro national level as well. Please, Dave.
Great. Yeah. Thanks, Daniel. Thanks, Caesar. Yeah. So on this first slide here, it's kind of focused on the DFW area and what our market research is showing. The chart that you're seeing there is from CoStar. And it's showing vacancy rates for the first half of 2023 and more historic rates as well. And so you can see in the chart that the strong occupancy that we experienced in 2021 and really peaked in the first half of 2022 has kind of come off its highs in the DFW area, and vacancy levels have moved back up to more historic norms, certainly to the levels they were 2020 and prior. The concerning trend that we're seeing is that they're still projecting to go higher still. So something we're keeping an eye on. We're not necessarily experiencing that within our own portfolio, which has kind of performed relatively well. We have seen a little bit of an increase in vacancy rates, but we're at around 95% of the portfolio level, which I consider to be relatively strong at this time in the year. So also kind of not in the chart, but something else that CoStar is reporting is kind of the year-over-year market rents have declined in the Dallas-Fort Worth area. Not much, roughly like 0.5% almost, and then effective rents have also declined almost a percentage point. We're seeing within our portfolio a decline in market rents, but not so much in effective rent growth, and I'll kind of get into that on the next slide is where we're seeing our effective rent growth. But however, I would say that other reports have come out in July. It seems like at the macro level in the DFW area, rents have kind of spiked back up a little bit, increased almost a percentage point year over year. So it's really in flux as we kind of navigate from the exceptional 2022 rates and vacancy rates and rental rates to kind of a more normal and expected market. So the only other item I'd like to note is that a lot of this performance that we highlight here in this chart, or as I'll talk about in the next slides, really varies from submarket to submarket. So a lot of submarkets that are kind of impacted more by new construction and new deliveries are feeling the pinch a bit more on market rents and concessions. And some of these other areas that are a little more stabilized or less deliveries, we're still seeing, good rent growth across the board. So, next slide. So this slide kind of focuses on our leasing trends that we saw through Q2. As I kind of touched on, market rents, they're flat, declining, and concessions are back. At some of our properties, and certainly within the market, we're seeing it from our competitors as well. The largest declines in concessions are happening in kind of Class A product. So the properties where we operate in the DFW area that are, in the better markets or better classes are actually experiencing the biggest concessions and the most challenging market rent growth. A lot of this is kind of not necessarily unexpected because that product in particular and those properties in particular had the highest run up in 2022. So you're talking, you can see in the chart here the portfolio rent growth going up 16, 17, 18%, last year around this time. Those were huge run-ups, and the Class A product led those run-ups. So now, it's the trend has kind of moved back, and Class A is also leading that as well. And as Daniel noted, consumer spending becoming a little more selective and earlier on, well, that's kind of highlighted within the Class A product, where you're starting to see people kind of maybe trade down a little bit or move out. It's not unexpected, and it kind of happens, whenever recessions occur, generally speaking, or whenever there's like economic slowdown. Anyways, people kind of try to save money and do different things, and we're seeing that a bit in our portfolio as well. And also, perhaps contributing to this is that a number of people who signed kind of in the May and June time period of last year really signed at the top of the market. And so, and as vacancy was tight and, the rents were high, they didn't really have a whole lot of options. Now, kind of in Q2, those individuals, their lease came up for renewal and they were kind of maybe looking to trade out, especially with concessions in the market. So all of that's contributing to, kind of a decline in overall market rents, but very modest, and kind of more modest effective rent growth. However, it's still, we're still experiencing effective rent growth, as you can see in the charts. And I think that's, important to keep in mind. So, as we're, maybe not advertising as high of rents, our effective rents are still increasing because as the leases trade out, we're able to kind of, lease them at a higher rent than perhaps the person who was in there before, particularly if it's been a long-term resident, maybe renewed last year, and then they decided to move out this year. There's that gap between their rent and the where we're able to lease, and we're kind of we're creating rent growth that way. Renewal rents are another place. This is like really an area of opportunity for us, as the margin is still healthy between a lot of our long-term renewals and the current asking rents at the property. So as people continue to move out, we're able to push renewal rates, and they've remained pretty consistently high at the kind of almost 6 to 8% range every month this year, as we've kind of driven our total income, through kind of renewals, and to a lesser extent the new leases. Another area we're I kind of touched on the last slide, but I'll touch on again, is the physical occupancy. It was we had we're about 95%, which I would consider to be a healthy level in June, but it kind of dipped from a higher level in April, which was around 96.5%. So we're still doing better kind of than the broader market that we're tracking, but there's certainly a little bit of weakness as well. And what we're doing to kind of address that is just offering concessions or kind of price discounts as needed, but being very selective when we do that. So I think you can jump down to the next slide, please. Okay. So on this one, we're just going to kind of talk about our areas of focus going into the second half of 2023. Occupancy, which I just kind of touched on, is really our key focus. Maintaining a strong average physical occupancy is kind of our top priority through the second half of 2023. Because what a high physical occupancy gives us is, it allows us to take advantage of the opportunities to push rents when we can. And so, we're trying to maintain 95% plus. And then whenever, we see the market kind of improving, we're in a position to really kind of drive our rents. In order to kind of maintain that high occupancy, we're focusing on our lease expirations and kind of tailoring our rents around that. So, we need to kind of balance our renewal offers with our expiration schedule. Something that we've kind of noticed towards the end of the second quarter is that our renewal percentages dropped significantly, actually the lowest they've been in years. Now it's just a 2-month period, and it's not, I don't want to read too much into it, but it's something we're keeping track of, just because, as I mentioned, a lot of these people signed at top of markets rents last year around this time. And so, with more opportunities, they're looking to kind of, potentially kind of trade down or get a better deal. So we're kind of managing our renewals, to kind of offset that a bit, particularly going in the second half of the year, because we want to maintain those strong occupancies. Other areas of focus include operating expenses. Year to date, our portfolio expenses have increased about 11% from 2022, and Q2 expenses increased approximately 22% year over year. Expenses, due to inflation, everything are up across the board, but really our primary operating expenses increases are focused on real estate taxes and insurance. Insurance is kind of the really difficult right now in the state of Texas. We have taken some, we've made some changes to kind of mitigate some of that burden, but not all properties, and depending on kind of the makeup of the property and the situation there, are eligible to be, for lower rates or to be moved to a different carrier that may be offering, a lower rate. So we're everywhere we can, we're pursuing to kind of reduce those and to kind of get them into programs that make the most sense and cut the costs, but certainly that has contributed to our increased operating expenses. And also the real estate taxes, that's another big line item. We've seen massive increases. Anybody who's invested or lives in the Texas knows that real estate taxes are kind of your largest line item. Fortunately, happy to report that the state of Texas has recently passed a property tax relief legislation, and we feel like it will, based on our kind of read of it, it should have a pretty substantial reduction in our property tax burden for 2023 and then 2024 and beyond. A big key component of that is a kind of reduction in the school tax millage rate, which is the largest tax millage rate in the state of Texas. And that is, or hopefully we'll see the benefit of that. However, there's also the assessment, which we always have to work to keep down, and other items that we focus on to try to keep our real estate tax burden down. And then finally, kind of our other cost cutting focus are just kind of marketing, administration. Labor is something else where we're kind of focused on as we're trying to keep items under control moving into the second half of the year. But generally speaking, those items have been relatively flat, and we've had a lot more success keeping them there compared to the previous years. And then finally, the only other item kind of we're focused on, it's not on the slide, but as we're kind of looking at leveraging technology. In Q2 we rolled out an AI leasing assistant that I think I've mentioned on some of these other calls. We're excited about the benefits of that, and we think it will save us considerable costs going forward, but also just improving our prospect communication and leasing processes at the property. So looking to make enhancements where we can, utilizing the new technologies that are coming out again going forward into the second half of the year. It's kind of my update for the operations. Hand it back to Daniel.
All right, thanks a lot, Dave. Appreciate it, and thank you, Caesar. Okay, so we had a couple questions come through, and we want to try and get to as much as we can. So some questions, some immediate questions. So one question is if we can put some metrics to the nature of the concession. So Dave, I mean, I guess in other words, maybe just, in very simple terms, what type of concessions are we offering at the moment?
Yeah, sure. It's we're using select concessions at select properties. So, that's it's difficult to answer, whenever we're talking about the portfolio level, what kind of concessions we're using. Not all properties are we offering concessions. In fact, most we're not. But where we are, you can see concessions ranging anywhere from, hey, we're just waiving an application fee or an admin fee to kind of give our leasing people something to talk about whenever somebody comes in the door, and create some sort of urgency. Hey, if you apply now or apply within the next 24 hours and your application is accepted, you don't have to pay our $200 admin fee. Yeah, that would be kind of on the lower end of the concession, and then we're offering all the way up to $1,500 off your first full month's rent at some of our properties. Now, those concessions change pretty frequently. So, if we're, seeing kind of an increase, we're getting the response we want, we'll cut them back, or we'll eliminate them completely. So, I can't give you kind of a specific, a good all-encompassing answer to that, but that, it's more of a targeted approach, property by property.
Okay, thanks. And I guess this kind of relates to it, but another general question that we received was, how has HLC's portfolio performed relative to the national average? So I think that's challenging, given so much data that's mixed all over the place, just in terms of how national average actually has performed. And you have to then break that down to locations, geographies, markets, submarkets, vintages, classes, so on and so forth. But you guys have any thoughts on that in terms of, if we can, speak to that at all, Dave?
Yeah, I mean, I think, broadly speaking, we're fortunate that most of our portfolio or multifamily portfolio is in the DFW area, which has, been experienced a lot of strength over the last, 5 years, and certainly last year, and is carried forward to this year as well. So our performance it's hard to kind of put the performance of our portfolio in the context of the national performance, but I feel like it's been relatively strong. We're certainly, where you're seeing, headlines indicating effective rent growth is down, or maybe negative, certainly diminished. As you saw in the previous slides, we're still seeing decent effective rent growth of 4% on new leases and 8% on renewals, and we've been able to push revenues during the first half of the year at pretty much all of our properties, and and we see reasons to be optimistic going into the second half of the year. So while it's hard to kind of again put it in the context of how it's equates to other markets and the nation broadly speaking, I think we're pretty pleased with our performance year to date.
Okay, thanks a lot. Appreciate it. And the next question is I think directed towards both Caesar and Dave, but the overall question is, when the Fed will reduce rates finally and mortgages will go down to be more attractive, that will fuel the market towards purchasing houses and apartments. That will influence renting in multifamily market as some of the demand for renting will vanish. What is your outlook? How much time will it take to see real impact on the rental market? So I think maybe what this is asking is, if and when, right? I think that's still the question, but rates go down, people can buy homes again at a reasonable, cost. At least the debt will be at a reasonable cost. Do we see that further impacting the multifamily market in terms of demand and maybe rents going down? Any thoughts on that, guys?
Yeah, I can take a crack at it. So at this moment, when you look at the average cost of owning a home on the national average, a monthly payment to own a home based on the median house price is about $2,500 a month. The median rent on the national average is $1,700 to $1,800 a month. So that's about $700 gap there. So right now it's more attractive to rent versus to buy, right? When interest rates go down, obviously potential home buyer will be able to afford this house. However, that would also push up the pricing of this home. And also, so that's one factor. Another factor of it is you look at the saving rate of American lately, it's the saving rate has gone down since pandemic. During the pandemic, the saving rate was quite high because everyone stuck at home, cannot spend. But lately, over the last 12 months, that rate had went down. And so those two factors alone, I think pricing of how price going up, if interest rate go down and people doesn't have enough saving to put the down payment, those will be a tailwind for multifamily. We'll still see a healthy demand for multifamily. During the downturn, our view is that we'll see a lot of demand for Class B multifamily because people are trading down. They want to save on cost. And where the market go back, we'll see, Class A start to have demand again.
Yeah. Okay, Caesar. Thank you. I think that also just an interesting thing to point out, and I think it speaks to the idea that generally, no matter what the market is, there is demand for multifamily. It's just how much, right? So it might not be the 15 to 17% over the last period of time, but you had a run of about 10 years of extremely low interest rates on mortgages for home purchasing, and that's when multifamily still the demand was so strong that it still witnessed some of its largest growth that it's had historically. So I think the exact numbers are still it's hard to tell, but I think historically you can see that they're somewhat segmented, and I think that those are great points what Caesar brought up in terms of consumer spending, and mortgages may be cheaper, but will people be able to have the down payment that they need in order to get the home? Another question that came through was our take on investing in strip malls with a good anchor like a supermarket or a pharmacy in the Midwest. So I can take a crack at that because that's definitely something that traditionally HLC and the principals have done. I think that nowadays, given where the market is, it's extremely market specific, location specific, and it can even be corner specific. And I think that one of the key items that when we, you know, we still do have a retail portfolio with some strip malls in the portfolio that's more of a legacy portfolio. And what we find is that you know, not only is it very intersection specific, it can get down to literally the intersection, but it's also very important that whoever is running that deal be you know, have very close relationships with all of the potential tenants, because those relationships can really drive leasing to the strip center. And so right now, if you know, I was doing a deal that was you know, a strip mall with an anchor tenant, I would first of all want most of the neighboring tenants to be something that was necessity based, such as medical. You know, you have spas, stuff of that sort, that places where people actually need to show up, that, you know, isn't as much of a threat to you know, from e-commerce. And also it's just really important. I would want to know that we have really good relationships with all of those potential tenants and the brokers who can bring those tenants, because it's a very competitive market, and the retailers more or less know that they have the upper hand, because there's a lot more retail space available than there is, especially if it's not a prime location. Other question that came through, let's just 1 second. Okay, so there's two questions that I'm going to kind of batch together. So we have one question was, does HLC anticipate any future capital calls? So, some of my other investments have been doing so. And then we also have a question here that in relation to rates, many investors are facing adjustable rate renewals, which is putting them under pressure. So how is HLC positioned in that regard? So we, as it pertains to both floating rate or adjustable rate debt and capital calls, early on when the Fed started raising rates, we, you know, thankfully HLC had very little exposure to floating rate debt, because we had played it very conservative, and it was very frustrating, honestly, over the last 4 or 5 years, you know, of missing out on many deals because people were bidding up prices and using floating rate debt. We had very little exposure. We still do have a small degree of exposure, but we took immediate action to shore up the balance sheets of those assets, to reduce leverage. In one case, we had a lease up deal and we reduced the leverage fully and were able to get into a fixed rate debt. Some people who are on the call are in that deal, and thankfully that deal you know, is now benefits from a 10-year Fannie Mae loan, and now it's just a solid brand new Class A asset that is you know, generating cash. And we also have one other deal where we basically raised additional capital in order to reduce the leverage on that deal. So other than that, our portfolio is primarily fixed rate debt. And as Cesar noted, we are tracking all of the loans that go into these securitized pools in order to see where we may be able to come in and purchase deals where people have you know, higher leverage. But that's kind of, so as of now, to ask the question on the capital call, we do not anticipate any further capital calls, and it is something that many groups are having to do right now. You know, primarily if they didn't act early, there were others that did act early as well. So that's on that topic. Let me just run through some more. We're getting a lot of questions in here. Okay, so another question is from a seasoned investor, real estate investor, and he's saying that in some of his more successful deals, the partnerships raise funds that hold off distributions for the first 12 months to get a kickstart on improvements, rent increases, and concessions, in order to, you know, kind of jumpstart so that there's and I guess that's a way to make deals work. So is this something HLC would consider to help make deals work today? So I guess the question is that something that we see as beneficial to do today? I mean, I think always in this environment, raising additional funds, you know, and building up a reserve or a war chest in any specific deal is you know, better. I don't know that it's going to make, you know, in general in real estate, you make money on the buy, right? And you make it also on the hold in terms of if you can hold for a longer period of time. I mean, those are really two levers that you can pull. So if you can buy it right, I think that that's most important. I don't know that holding off on the distributions today, I mean, it can help a deal, but if the deal is not bought at a good basis, then, then it's not gonna, I don't think that's something we're gonna want to own. I don't know, Caesar, Dave, you have anything that's on that?
Well, I can just add that, a lot of the ways that we've structured our partnerships in the past is that instead of holding off on distributions for the first 12 months so that we can, do improvements or, whatever, take actions that will kind of improve the property and move rents. We've actually just generally raised, we've kind of identified those costs up front, and we've raised a reserve fund to address those needs. So our capital improvements are kind of happening simultaneously with distributions that are from cash flow. So that's, there's different ways to do it. And certainly, you could raise less money up front and use the cash flow from the property to, to kind of fund some of that stuff. We've generally selected the what I just kind of highlighted, kind of, hey, we're going to raise this money and we're going to use it up front, and we're going to make distributions kind of out of the gate, if we can. It has not always been the case, but that's typically the strategy we use.
Okay, thanks a lot. Caesar, you have anything to add, or does that cover it? No. Okay. Another question that came in was our take on industrial investments and warehousing. So I think that's not an area that we necessarily focus on, but it definitely is an area that, I think obviously it's a growing sector, both industrial and warehouses. There's increasing demand. We're seeing it, and we see, that we see it in the pricing as well. I think that kind of it's one of the darlings of real estate over the last several years. So it's a very, well priced and hot market. Caesar, do you have any thoughts on this? I know you do. Actually, I shouldn't ask. I know you do. So
yeah, we actually we haven't bought any industrial, but we actually do track the performance of industrial sectors, because those are the driver of job growth for multifamily. And we track that a lot. And we also tracking shippings, to understand how corporations are doing in terms of, consumer spending. And those will dictate our thesis in terms of where we'll invest our capital. We tend to like kind of market that gateway for industrials, where a lot where our investment will know for sure that they will have a lot of jobs that cater to the overall populations. And so we won't buy, but we actually tighten them a lot. I mean, it's not attractive to buy industrial because cap rate is sub 4%, and the vacancy is sub 2%. So we don't see a lot of upside, but if they do drive a lot of growth for our side.
Okay, great. Thank you. Thanks, Caesar. Okay, there's one, there's a couple more that came in, but I think that we have time for one more question. So let's, with the potential slowing of the Sun Belt region, are there specific property sectors or geographic markets that HLC is currently favoring for investment, and what factors contribute to that? So I think that we are constantly looking at new areas. I think that, as Caesar pointed out in his presentation, the Sun Belt still does have significant demand. I mean, Caesar is currently in Atlanta, and he's witnessing every day the growth in that area. And we see in our portfolio in Dallas, even with the softening of the economy, I think it's more of a reflection of this overall softening, and and also the immense growth that's happened in that area. But there still is, from those areas and those regions are still growing, but it could soften, and we're actually more looking at other areas in order to see where are some areas that we could get good pricing on the buy, and then also there are good, strong fundamentals in terms of cost of living and potential for rent to grow. Right, so there are specific areas in the Midwest, markets that we are looking at, and we've gotten pretty close to some deals in Columbus. We have of course some some of our portfolio in Oklahoma, and we are looking at expanding that. I don't know. Do you guys have any other thoughts on that subject? No.
Yeah, not at all. I think, from our end, we usually take a long-term whole approach to all our investment. So as Daniel touched on, Sunbelt markets, strong fundamental, a great place to invest in, but Sunbelt market are becoming touching that point of become somewhat unaffordable. In the future. So we are looking a lot of Midwest market and secondary market where it's a lot more affordable and will drive migrations eventually. So, but we haven't, we haven't go out aggressively buying deal because we want to really understand the market and also pick up deal on a good basis. We've been bidding on a lot of deals, but for us, staying disciplined is the key.
Yeah. Okay, I think that we're going to wrap at that. Thank you, everybody. If anybody wants to check out, we released a CEO letter, our quarterly letter. Here is the URL that you can get it at, and you can also just access it from our website if you go onto our website. But it's HLCEquity.com/July CEO letter. Looking forward to what's coming, and looking forward to being in touch with everybody. We appreciate everybody for joining, and we will be in touch with everyone soon. And if there's any questions, please feel free to reach out afterwards. Thank you very much. Take care, everyone.